The game has changed. Hi everyone, this is Matthew Case. Welcome to Audit and Assurance. Today I'm going to teach you about the ethics and acceptance. We are studying what's right, what's wrong. We all know what's right, we know what's wrong. Why are we studying it? Accountants might face an ethical dilemma. So you need to know the right thing to do when you're involved in some situations. Accountants, or we say auditors, need to behave in an ethical manner, need to behave, number one, and number two, to be seen to behave in an ethical manner. I hope you understand what I'm saying. As an auditor, you need to behave in an ethical manner. At the same time, you need to be seen to behave. Like this profession requires trust. For example, you had KPMG, or it might be Deloitte, it might be Ernst & Young, it might be a PwC. You should be able to trust them. For you to trust them, they must be independent. Think of a pastor and the church members. As a pastor, you need to be trusted by your church members. You understand what I'm saying? You might be doing the right thing, but if you lose their trust, things won't go well. So now, looking at our ethics, I want you to understand the ACCA fundamental principles of ACCA Code of Ethics. I have an acronym for you. We call it the PICO. Think of this, PICO. Just think of Dr. PICO, then you pass your exam. So P for what? P for professional behavior. I for integrity. C for confidentiality. Another C for competence and due care. Then O, we have objectivity. Now, I want to explain these principles. These are the principles that you must follow as an accountant. These are the principles that you must follow as an auditor. Right. We have the professional behavior. What are we saying? The behavior. We are talking about an accountant being able to comply. So we say accountants, you should comply with relevant laws and regulations. Comply with laws and regulations. Yes. And we are saying avoid actions that discredit the profession. You understand? Then about integrity is about being honest in what you do. So we say accountants should be honest and straightforward in all business and professional relationships. Then confidentiality. Now, when you're talking about confidentiality, we are saying as an accountant, think of this. You might have the sensitive information about the company. So you must not disclose that information to other people without being authorized. In other words, I'm saying you should not use information for personal advantage. You can do this, for example, going to your competitor's company, then you say, I work from this company, we are planning A, B, C, D things. If you want me to tell you what you are planning so that you can also cope up, so that you may also lead in the industry, I can give you this information. That's illegal. You can't do that. So in other words, you are saying confidentiality. Respect the information that you've acquired. So confidentiality, when you have sensitive information about the company because of your employment, we are saying respect the information that you have acquired as a result of professional and business relationships. And you should not disclose such information to third party without proper and specific authority to do so, unless it is a legal right or duty to disclose. You understand? Right. Then now on competence and due care. When you say accountants, when you say auditors, we are not worried about competence. Because when you say accountants, Mr. Auditor, you have the knowledge. But the challenge is on, are you able to maintain the knowledge? Are you able to maintain the knowledge? So competence in due care is you being able to maintain the knowledge at a level that is required by your client. We are saying you should not regret. They should not regret that the audit firm that we hired, these people, they are not that good. We are saying be competent in the industry at a level required by your client, even your employer. So how can you maintain the knowledge? Someone is an accountant, someone maybe studied the professional course 20 years ago. That's why ACCA requires you to attend even some trainings that they do, might be every 5 years, so that your knowledge will be up to date. Right. Then objectivity. Objectivity, we are saying you should not allow bias, conflicts of interest, and influence of others to override your judgment. So we are saying be objective. Let me tell you this about being objective. Everyone wants to be objective, but the challenge is there are some threats. There are some threats. What are threats? We're talking about things that causes you not to be objective. For example, let's say you as an accountant, you know that when someone commits fraud, you have a duty to report. You're at your organization and you discovered that fraud was committed. Then you are investigating. Then you discover that the person who committed that fraud is your close friend. Now, you have this dilemma. Yes, you have a duty to report. You want to report, but now you're afraid that you'll not be in good relationship with that person. There's no more friendship. You're worried about that. At the same time, you choose not to report because of the friendship, but you know that, no, I'm not doing the right thing. Are you seeing this? So that's why now we have to explain about the threats. One, we have the self-interest threat. Number two, self-review. Don't know what I'm going to explain. Number three, we have familiarity. Number four, what do we have? Intimidation. Number five, we have the advocates. Right. Now, these are the threats that causes one not to be objective. Number one, we have the self-interest threat. Self-interest threat, this is a financial interest that you might have in the client. The financial interest. I'll give you so many examples. For example, on this one, maybe you own shares. All right. Think of this. You work in an audit firm. Maybe you're 6. You are sent by your senior to a certain client. So they will tell you that you guys, you'll be dealing with this client. But the company that you're auditing, you own shares there. In other words, we are saying you are the shareholder in that company that you're auditing. So imagine you discover that the financial statements are wrong. Imagine you discover that there are so many things that aren't correct. Will you be able to report? No, because you're not independent. It's your company. Because if you report or anything, it means the company that is losing value, it is your company. So it is likely that you overlook some of the things. So what are we saying? What's the solution? What is the safeguard? We have threats, we have the safeguards. Measure, a safeguard is an action or measure that is taken to reduce that threat. If you own shares in that company, we are saying you should not be part of the engagement team that audit the client. You can't audit your firm. You can't audit your company. You should not be part. If you want to be part of the team that audit the company, you are required to dispose of your shares. If you don't want, it's not by force. Yes, you work in that audit firm, that's fine. But if you want to be part of the team that audit that company that you have shares in, you dispose of your shares first, or if you don't want to dispose, you cannot be part of the engagement team. I hope you understand. Right. Another example on the self-interest, we can talk about the gifts and hospitality. Now, gifts and hospitality, we are saying an auditor should not accept gifts and hospitality. You should not accept gifts from a client, because I want to tell you something. People know about bribes. Imagine someone trying to bribe a police officer. But now it's now different with audit now. People, they don't bribe in a way that people do when they're bribing the police officer, saying, police officer, I'm really sorry. You understand? So people are bribed indirectly. I want you to imagine this. There is an engagement team and the senior. Then the client say, guys, we want to thank you so much for what you do. You know your staff, your audit is good. We really appreciate. We have decided to buy a car for the senior of the team. Imagine then, let's say the audit senior is accepted. 3 months down the line, or say 1 month after, then you discover that this company has been doing money laundering. Will you be able to disclose that? Remember, you accepted a car. So you feel indebted to the client. You will not be able to report. Are you seeing this? So then you start to balance things to see that, okay, so that's why they bought the car for me. So this is a bribe. You understand? So in audit, we are not allowed to accept gifts and hospitality, because you might be receiving bribes indirectly. We say in audit, we say gifts and hospitality should not be accepted unless they are trivial and inconsequential. What are we saying? You can only accept if they have an insignificant value. If they don't have a value, you can accept. For example, maybe you've been doing work at the client's firm, at the client's company, you've been doing the work. Then maybe it's lunchtime, they've decided to buy you a drink. You can't say, no, I'm not accepting, it's a bribe. It's trivial, my guy. It does not have value, you can accept. Even though if things are trivial, for safety reasons, it is required to document. Those things that you've accepted that are trivial, they should be documented for future use. Right. Okay. On shares, gifts and hospitality, there are so many things, the fee, dependence, litigation with the client. There are so many examples about the self-interest rate. When we say you have a financial interest in the client. For example, loans, they cause the self-interest rate. So we are not allowed to lend each other money with the client, even overdue fees. In audit, we say no work should be performed until the balance has been paid, the overdue fees has been paid, even contingent fees. The client can say, please, can you do the work for us? We will pay you in the future. No. We are not allowed to do that. We end up being desperate. Imagine now the client has our money and we have been auditing and we discover some of the things, maybe we want to report the client to the government. Imagine this, someone owes you maybe $500 for argument's sake. Will you wish that person to be in trouble? No, obviously, because you also be worried about your money. You want your money back. So imagine the client has our money. We want the client to pay us first. So we won't be able to report some of the issues because we are desperate for our money. So that's why we're not allowed to do that, to do the work before the money is paid, or to lend each other money. Self-review. Imagine this, self-review. I look in the mirror, see myself. I'll just say, this is nice. I'm looking good. You understand? I'm not saying it might be correct all the time. I might be wrong. Someone will say, no, you're not looking good. But I want you to understand this. Let's extend this idea. Self-review, when you do a self-review, the opinion might not be right. So self-review occurs like, let's say you write an exam, then you want to mark that exam yourself. What do you think is the risk? There's a risk. If I write an exam and I want to mark that exam, number one, I would tell myself that if I fail that paper, I'm going to cheat. If I get even 48, I'll add maybe extra 4 marks. You understand? For example, you have an intention to cheat if you get 48%. So if I get 48%, it's likely that you can cheat and you add few marks, then you say, I got 54%. You cheat. That's the problem with self-review. Number two, let's say you had an intention to cheat, but you didn't. You write the exam, then you get 62%. Then you say, I passed, so why would I cheat? But the challenge is, what will people say when they hear that you got 62%, you are the one who marked that paper? Will people believe you that you really passed? They say, obviously, the guy cheated. You understand? They won't believe that you passed. They believe that you cheated. Extending this idea is the same with audit. You cannot prepare the financial statements and audit the financial statements. Self-review occurs when we prepare the financial statements, because in audit, our duty is to audit the financial statements. In audit, our duty is to audit the financial statements, not to prepare. Remember, when we audit, we do comments and we do correct the client. The client might say, auditors, you are very good. What if you prepare the financial statements and audit them? We'll give you your money, yes, your money for the audit and your money for preparing the financial statements. We can't prepare the books and audit them. This will be the same as writing an exam and marking that exam. So that will be self-review. You'll be reviewing yourself. Number one, the challenge is people will not trust when we say the financial statements that we've audited are correct. People will not believe us. That's the number one challenge. Number two challenge, even if we make mistakes, we won't admit to our errors, because we are the ones who prepared. We can't say when we are auditing the financial statement, this financial statement, there are so many errors. Remember, you are the ones who prepared. So anything that has to do with preparation of financial statements, it's a self-review threat, such as preparing financial statements, doing tax services. It might be helping the client maybe on valuing their non-current assets. Anything that has to do with the financial statements, that has to do with preparation, that's self-review. Moving on, we have familiarity. Familiarity threat is caused by two things: long association and personal relationships. So if you're auditing the company for so many years, it is likely that there will be familiarity threat. In audit, we say if you audit a client for more than 7 years, there will be familiarity threat. So what do we do when you audit a client for more than 7 years? They have to rotate the engagement team. Put a team that you have not associated with the client before. People that have not associated with the client. This is all because we need people who are independent. And also, as I've said, the long association and the personal relationship. Imagine you're auditing a client where you have some personal relationships. Maybe the finance controller is your cousin. The finance director maybe is your uncle. In that case, you are not independent. So when you are in the engagement team, we are saying do the right thing, be ethical. You have to report to your audit firm that I can't be in this team because where you want us to audit, I have some personal relationships. We are not saying if you know anyone, you are not independent there. We are saying if you are related to people who can influence the preparation of the financial statements, which means that if you have a relative who is a junior or who doesn't have anything to do with preparation of financial statements, it does not affect your independence. You get it? That's familiarity threat. We also have the intimidation threat. Yes, intimidation threat, like receiving pressure from the client. So imagine you guys auditing the client, auditing the financial statements that are being prepared by someone who you used to work with or who was your senior in the audit firm. That person might intimidate you. Right. Then the last one is the advocate threat. This occurs when you represent the client. We are not allowed to represent the client in any way, like promoting the client or maybe representing. For example, the tax authorities might be arguing with the client, saying that we are not trusting your financial statements. The client might say, no, you can even ask our auditors. Imagine this now, you are representing the client, maybe in court, you're defending the client, we audit the financial statements, no, guys, they are correct. No, we're not allowed to do that. If they want anything from us, we just tell them the accounts are published. They have to go and read the audit report. We should not represent the client in any way. Because people even will start to ask questions. Why are they representing? Are they receiving bribes? Right. So guys, these are threats that you must know. Threats to objectivity. When you are auditing the client, we receive a fee. Yes, obviously we don't work for free. There is a fee. The audit fee, we say the audit fee, it should not exceed 15% of the client's total annual revenue. Giving you an example, let's say the revenue of the client is 1 million. So which means our fee per year, what's 15% of 1 million? If you do the number crunching exercise, that's 150,000. So which means our fee should not exceed 150 if the client is earning 1 million per year. Why is that so? Imagine you receiving 150 guys. This is revenue, this is not profit. It means you're earning more than the owners of the company, than anyone else. So it will be believed that if you are receiving an annual fee which exceeds 15% for 2 consecutive years, they will believe that the extra amount is a bribe. So guys, this is it. This is ethics and acceptance. So thank you very much for your time. Let's say bye-bye to ethics and acceptance. See you in the next lecture.